I don't usually say much in these sessions. Young is the one who really does a lot of the work and the active work. But this is just our first meeting for this semester. Welcome to everybody. I think this is the 7th semester we've had this accounting design project, and we're very heartened that given the Zoom technology, which I guess COVID introduced us to, we've been able to have a worldwide audience, and I can see there's people from all around the world on the screens here. We're very heartened. There's the papers we've seen, and I think we have now about 60 papers archived on the website, so they're all there for you to go back and look at again. Some of them still in working paper form, but you can get updates from the authors. Just let me remind you of the purpose of this. It's called the Accounting Design Project because Young and I, and as well as many of you, see our core mission as accounting design. Accounting can be anything you want it to be. And we know managers want the accounting to be the way they want it to be. But that may be different from the way shareholders want it, and may be different from the way debt investors want it. And it may be different from the way you want to do it if you're reporting on ESG issues. So it's a design, it's accounting at the heart of the design issue. And we feel that everything we should do ultimately should, as accounting professors and PhD students, should culminate in saying something about what's good accounting and what's bad accounting for the purpose in hand. So that's the focus. We continue to get many submissions, more than we can handle. Please keep them coming. So we're very gratified that there's an audience here from around the world, and we hope this semester is as good as or better than even the previous semesters. So welcome, and have a good semester.
Thank you, Stephen, for this great introduction. I'm the moderator for today's session. I'm Jetson Peter from UT Dallas. I'll try to be brief. I could spend 2 hours just talking about our speaker's accomplishments. As you all probably know, it's nothing short of an honor to introduce our speaker today, Patty Dechow. Just a brief introduction. She needs no introduction. She's a reference in her field with numerous research awards, teaching awards, mentoring awards. Professor Dechow is the Robert Duction Professor of Business at University of Southern California. And today she's going to be talking about a rating system to evaluate non-GAAP exclusion quality. Just a few house rules, general guidelines. I already typed them in the chat, but just so we can have a productive discussion, please mute your mics if you're not talking. This is to avoid background noise. If you're comfortable, please turn on your camera. It's better for us to communicate, like seeing each other, right? If you want to ask a question, raise your hand on Zoom or type in the chat. I will monitor the chat and give you the voice in order. The first 5 minutes are uninterrupted, such that like we can get the research question, and also the last 5 minutes is that we can have the concluding remarks, okay? And I will try to make sure that everyone can ask questions, but try to minimize the number of follow-up questions that you have, at least in one interaction, so that everyone can speak, okay? And I will keep track of time. With that, Patty, the floor is yours.
Okay, thank you very much, Judson. Can everyone hear me okay? Hopefully. Yeah, and thank you, Stephen and Young, for selecting this paper for your seminar series. So this paper's with Wei Ting Lo, who's at Singapore Management University, and Annika Wang, who's at Houston University, and they're both on the Zoom meeting today, and they can answer any questions if you get too technical or I don't want to answer the question. So anyway, so this paper's on a rating system to evaluate non-GAAP exclusion quality. Oops, so are you looking forward to the presentation today? Hopefully the answer is, 5 stars, yes. So I think when you see the 5 stars, you can pretty quickly get an idea of what I'm trying to do there. You know, a rating system, when you have 5 stars, 4 stars, 3 stars, when you go to a restaurant or a hotel, it gives you a pretty quick summary measure of what other people have thought of that particular place. So we see rating systems that has having some positive benefits, such as a clear scale for comparison. It's a really easy way to communicate information. If you say 5 out of 5, everyone kind of understands it. I mean, we all suffer with this with teacher ratings, I guess. It provides guidance to customers on picking products and provides guidance to firms on what customers think of them. But the downside of rating systems is that you lose complexity, they can be noisy, people can game the system, and also raters are heterogeneous. So how people view restaurants or any other item, it varies by their own preferences. So our objective in this paper is to score non-GAAP exclusions and then develop a summary measure of a non-GAAP exclusion quality. Just because we feel that, the time, as Stephen just mentioned, the time has come to really try and evaluate all these non-GAAP exclusions that are occurring. So I'll just give you a brief history of non-GAAP earnings for those of you who are less familiar with this area of research. So investors use financial statements to forecast the future benefits from investing in business. So they're interested in understanding future earnings, cash flows, dividends. And so this leads to a primary focus on the recurring component of current earnings, also known as core earnings. You'll see words like normalized earnings, even valuation earnings and operating earnings out there. But US GAAP and the FASB and IFRS don't define such a measure. They tend to have a balance sheet focus, and the rules have kind of moved towards this focus on trying to value assets and liabilities in the balance sheet, rather than being income statement focused, trying to get a better measure of firm performance. They did put this project on their agenda, and it was there for a few years, but since then they took it off. So we're going to see non-GAAP earnings for the indefinite future. So anyway, to fill this void between what the standard setters are requiring of earnings and what investors want from the earnings number, managers make up their own non-GAAP measures and report these to investors. But the problem with this approach to producing a performance measure is that managers also have this incentive to overstate the measures. So there's been a couple of SEC enforcement actions where the SEC has gone after firms and said, that their non-GAAP exclusions were inappropriate or misleading. And this led the SEC to Regulation G, which was released in 2003, and it required that the non-GAAP financial measure could not be misleading. And they brought in this rule that the non-GAAP measure had to be comparable to the GAAP financial measure. So they had to report the GAAP financial measure first, preferably, and then give it equal prominence. And then if they were providing forward information, they should also provide this non-GAAP reconciliation. So there's usually somewhere in the press release, you'll find this reconciliation, but it might be very, very far in the document. It's often very difficult to find. And the SEC continues to interpret, try and work out what to do about this, because the standard setters are not doing anything. That's the thing to realize. The FASB is not taking an active role in trying to get a core measure of earnings. Why do we think it's important to rate non-GAAP exclusion? Well, there's this rising use in non-GAAP EPS. So back in 2003, 51% of firms reported. This is for the S&P 500. 2020, 75%. It's actually higher than that. Just depends on what sample you use, but a lot of firms are reporting it. And in addition, management really care about meeting analyst expectations. So in this survey by Rival, 76% of managers in the US said that they were concerned or very concerned with meeting consensus earnings produced by the analysts. Another reason why we think that producing this non-GAAP measure is important is because there's a wide array of exclusions that companies are making, so they can be very difficult to interpret. So you have like discontinued operations, some firms excluding depreciation and amortization, others excluding M&A costs, .comp. And so as an investor, how do you know whether it's good or bad, right? Is it a reasonable exclusion or an unreasonable exclusion? And we felt like this was another reason to go ahead, and as academics, we can be more independent and decide on these things. Another reason we feel that a non-GAAP exclusion score is useful because managers themselves seem to vary in what they believe is acceptable or unacceptable to exclude. So here, the last figure here was just the whole, looking at the number of different exclusions from the S&P 500, but it doesn't take into account whether a firm actually has that item. And in this figure here, we're saying, well, given that the firm has a litigation settlement, what's the likelihood that they'll exclude it? So given that they have that item, 94% of firms exclude litigation settlement costs. So that gives you a pretty clear idea that management themselves think this is a reasonable thing to exclude. It's unlikely to recur, right? And it's got no value relevance once the information's already been incorporated into price. Same with restructuring charges or M&A costs. On the other side, down at the bottom end, what do management tend not to exclude? So when you see it, it does look a little bit more unreasonable. Depreciation and amortization, about 47% of firms exclude that. Oh, do you have a question, Ayang?
Yeah, we have one question.
Hi, Patty. I just have like two general questions. One is related to the chart. You show that more and more firms are actually providing non-GAAP earnings adjustments. Sorry for my voice. And then one thing what we see in the stock returns and earnings is that over time, over the past few decades, we have seen idiosyncratic stock returns has volatility has increased over time. Cross-sectional earnings dispersion has increased over time. So it seems to suggest that heterogeneity across firms' fundamental transactions has increased over time. Do you think that increased heterogeneity somehow is the motivation for more firms providing non-GAAP exclusions or adjustments and also more line items to actually signal that they actually have a slightly different business models or transactions from the uniform accounting system dictated by the US GAAP?
That would certainly be consistent with them wanting to report their core earnings, right? Because they'd, because you can sort of think it as gaming companies and technology firms where they have a lot of, the rules don't work very well for them for deferred revenue, for example, and they report bookings instead and things like that. So yeah, I don't think that the standard setters have kept up with the times or kept up with the different types of business models. Maybe it's too rigid, right? The FASB rules. And it's not providing necessarily meaningful information as far as the firm's concerned because they're more concerned with the income statement, right? So yeah, I think that could be a good reason, that there's more heterogeneity in business models. Yeah.
So one follow-up question is that if you go back one slide about the count, right? I think I'm looking at pension-related expense. The next one is that over 80% of your sample firms exclude pension-related expense. And before I read your paper, I thought if the heterogeneity is one significant motivation for excluding those line items, you will go back to the fundamental transactions. For example, whether a firm with a frozen pension plan versus ongoing pension plans to actually try to disentangle the differential fundamentals and reflect that in your rating system. But I think currently your rating system also assigned homogeneous score for each line item to all the firms, right? You don't recognize that firms maybe have a different business transaction that may potentially signal different quality. So I just want to hear your thought on that. Or maybe that is your next project. This is the first one and then the next one.
I do feel like this maybe is more than one project worth of thought because there's a lot of academic considerations, right? Because even you'll see when we come up with our rating system and like talking to academics, it's always really hard to know how to classify an item because there's always, you know, a alternative viewpoint. So with mergers and acquisition costs, for example, I find them, you know, kind of like, I don't really think they should exclude them. But then again, I don't really like the accounting because I think they should be allowed to capitalize it and amortize merger and acquisition costs. But when a firm is in the business of doing acquisitions, like many pharmaceutical companies just acquire other companies to get the patents and so forth, you know, it starts getting really suspicious when they start excluding M&A all the time and amortization expense. You know, it's all like, that's your business model. What are you doing? But then I don't really like how the accounting works. So, but then if a company does it once, then I think it's fairly reasonable to exclude it. So this is getting to your point that it would be nice to know more about the specifics of the company and develop a system that was more focused on the actual firm. But, you know, the three of us don't have the resources to do that right now, you know, but if people are interested in this, it's certainly an avenue that we, you know, that could be explored more deeply, just like getting a better system that's more focused on the individual firm and more detail. It's just like rating systems in general have that problem, right? That they're a course that they, you know, just a summary, just like with a restaurant, you know, there could be different nuances that you might want to know about in the rating system. Yeah, so it's a good point.
I think there was a comment on the chat related to this pension, just asking from Basu whether pension expense are based on fair value. So could it be that this is like less useful for forecasting and maybe that's why they're removing from non-GAAP?
Yeah, I think so. Yeah,
So-
definitely these pension adjustments, you know, especially back in the day. I haven't done intermediate accounting for a while, but I've heard it's changed a bit. But, you know, just all those adjustments to fix things up and smooth and, you know, that focus on the balance sheet. You can imagine that justifies them excluding a lot of different things. So, yeah. And here are some of the other exclusions that are less, given a firm has them, they're less likely to exclude. So, or depreciation amortization, 47% of firms sort of come up with some kind of EBITDA number that they focus on. Discontinued operations, I would have thought much more firms excluded that, but I guess not. Inventory write-downs, about 33%. So you get a kind of idea of what firms also think are reasonable or unreasonable exclude. And those color codes you'll see are related to our system. So green we think is good and red we think is kind of bad. So you can see on this slide there's more greens because we agree with managers, I guess, on some of those ones. And finally, another reason we think a non-GAAP exclusion score might be useful is just that industries vary in the type of items that they exclude. So, you know, I feel like we kind of think, well, some industries really have kind of low quality earnings or exclusions, and other industries, they seem more reasonable. So in real estate, they exclude depreciation, and in mining, but seems like that's a pretty normal charge, really. And then, you know, other industries tend to exclude stock compensation. And so you can kind of get more of a feel how industries vary as well, which I think is an interesting aspect to looking more deeply at the measures and getting a measure that you can kind of compare firms more easily. So with developing a rating system of non-GAAP exclusion quality, the first thing that we did was we sat around and said, well, what do you think the objective of non-GAAP earnings is? And as I mentioned earlier, we believe that managers provide non-GAAP earnings to help investors understand the earnings generated from core operations and try to distinguish recurring from non-recurring items so that they can provide more useful information for valuation for investors. So we're saying with the intended users as shareholders, and the objective is to provide a more informative measure of performance. So that's what our focus is, right, in this paper. And so we can't.
Oh, sorry. We have another question in the chat. I don't want to interpret the question. Albert, do you want to ask the question, or do you want me to ask the question for you?
Oh, I think it's sorry to interrupt. Yeah, it's a pretty simple question. I was just curious, like, you notice that there's a lot of heterogeneity across industries. I'm just curious, like, what about across time? Do you see the firms that are excluding stock-based compensation continue to exclude it every time? Like I would imagine over a firm's life cycle, stock-based compensation is something that declines over time, for example. I know this is not the focus necessarily of your study, but given that you have the data, I was wondering if you observed that.
Yeah, so we did find, we try and look at that, and we do find there is persistence in what they exclude. So if they excluded stock comp last year, they're going to exclude it this year. You know what I mean? Like there is that kind of serial correlation with items depending on their actual AR1 process themselves. So yeah, you do see firms doing it consistently. So we provide some results showing that there is this consistent reporting, and they also seem to exclude certain items for comparability to be like their industry. So yes, your intuition is correct that they do. I mean, it'd be nice to have a longer time series and get a better feeling for that, but we've got what we got. Yeah, so what I'm doing here is just decomposing GAAP earnings into accruals and cash flows, like that, and then decomposing them further into accruals that are transitory, accruals that are neither transitory or persistent, and then accruals that are persistent, like depreciation expense, for example, and then also cash flows into transitory cash flows, you know, these one-off things, cash flows that are persistent, and then cash flows that have this kind of mixed attribute. And then from there, if managers want to help investors understand the economic nature, the accounting rules and the valuation implications, then what we feel like they would want to do was choose to include persistent items and exclude transitory items. So then we break down GAAP earnings into non-GAAP earnings and total non-GAAP exclusions, and we do this other breakdown, and then we say, well, if managers have information, they've got these dual incentives to convey information that's relevant for valuation, but they've also got this incentive to perhaps manipulate the choice to make the firm look better. So we argue that high quality exclusions will be transitory in nature. That will be one aspect of them. So transitory cash flows, transitory accruals, whereas low quality exclusions will have this, be more likely to persist in the future. You'll see them in future periods. And then neutral ones have this kind of mixed attribute where it's more difficult for us to determine whether they're transitory or persistent. But we also go beyond that and consider the economic nature of the item. So we don't just look at the AR1 process of the particular non-GAAP exclusion. And so we developed this kind of scoring system of the non-GAAP exclusion, where we look at the economic nature, how things are measured, and then their valuation implications. So are they relevant for future earnings or cash flow forecasting? So we classify things such as depreciation, amortization, and interest expense as low quality just because they are persistent. You see them every year. They're relevant for valuation. Interest, I don't think anyone would argue, is a relevant expense. And then with depreciation, well, the company should either include the CapEx or the depreciation. You can't exclude both. And we see the depreciation just being as a proxy for the CapEx, so we believe it's relevant.
We have one question if you want to take it up.
Yeah, James.
Hi, Patty. Kind of looking at this slide here, I noticed kind of if you're, excluding depreciation and amortization as well as interest, you're almost getting kind of a debt covenant sort of measure. A lot of them are using these adjusted EBITDA numbers. And so I was wondering if you kind of among the low quality excluders find a lot of folks who are kind of debt dependent and need to signal something about their liquidity, their kind of ability to meet debt covenants.
Yeah, I think that's a really interesting avenue, really super interesting question. And I talked to Peter
Might be a little
Demisian
much
about
for
it.
the scope of the paper.
Yeah. Well, I did. I asked Peter Demisian about it, and I said, oh, look, can you tell me what they put in covenants? Because I think it'd be really interesting to looking at that side of non-GAAP exclusions, the covenant side. But as you pointed out, we decided, okay, let's just focus on the share valuation in this paper and try and think of a measure. But you could see that it could definitely, that's a really interesting avenue for future research, just trying to get a better grip. And I feel like by having this non-gap exclusion quality hour rating, it will give other academics an opportunity to go and explore things and say, hey, they said this, but they were wrong, or whatever, or it doesn't hold in this circumstance because these kind of firms, it's really relevant for their covenants. Because we have this problem with the accounting system not being focused on what managers necessarily or investors want, or even, as it turns out, debt holders are excluding items as well. So yeah,
Thank
I
you
think
very
that's
much.
really interesting.
Patty, we have one more question, and from Pasu, do you want to ask or prefer me? I can ask.
Go ahead.
Oh, hello, Sudipta.
I'll try to do justice to the question. Could it be that the disclosures also affect compensation through the bonuses?
Oh, yes. Yeah. I think, don't you have a paper on that, James? I'm trying to remember. Anyway, yeah.
do.
Okay.
You do.
I thought you did.
Your
I
94
think I was the
target.
editor. Yeah. So
Your
yeah, I
target
do. Yeah, so I do think that that managers, that board of directors also view earnings as having problems with transitory components, and so they are also excluding items. And so you've got the same problem going on there, where they could be excluding items that are being opportunistic, or they're actually trying to get a more relevant measure for evaluating the managers. So yeah, that's another aspect. So you've got compensation contracts, debt covenants, shareholders, very important groups, and we thought about writing the paper to try and be more inclusive, to try and talk about all that, and then we're like, oh no, we should just try and keep it more streamlined and trying to have a clearer objective. So that's why we end up going with just the valuation shareholder point of view, because it kind of gave us a clearer focus for developing our measure. But but I think all these points are really valid and would be interesting to explore further and see how the measure, how our quality score, compares for these different uses of the number.
So from FASB's viewpoint, I think that focusing on shareholders makes sense. But from the manager's viewpoint, I think it makes less sense to do that because they have to serve all of these needs. And so then the question is, why start with the FASB as the benchmark when you're trying to model manager behavior?
Well, I don't think that that's correct in the sense, sorry, I shouldn't say that. You never say that in class. I think that the FASB doesn't have a very clear link between what their objectives are and what investors really want, right? They think that they want all this valuation stuff, the balance sheet approach, but they don't actually talk to many investors. I'm only saying this because Richard's on the FAF or whatever, the board that decides on accounting rules. And, they don't have many people who represent the investors. And so it's mainly just accounting partners and regulators and people like that. And so I don't think they really have that focus when they're making the rules anyway. So even though they claim that they care about shareholders, their rules are not, I don't know what their rules are for. I guess it's bad that this is being recorded because should be more, but so I think it's one of the aspects.
We can edit it out. I think we have one more question for Paul. Please, Paul, go ahead.
Hi, Paul.
Yeah, hi, Patty. I have to give you credit. I think this is an extremely difficult problem to tackle. An analogy that comes to mind is trying to separate normal from managed accruals. Which as we know, is so tied up with the business model and what's really going on. And, we've had a long history going by, probably before Jones, but I just wanted to give you credit for I think this is a very, very difficult problem I'm very serious. I give you credit for this because to try and separate, what's even on an industry level, what some firms are doing, which is opportunistic versus, as you say, others trying to provide more information I think it's really analogous to the managed accruals problem. So good luck, but I think it's very difficult problem.
Yeah, I think that's true. I agree with you. It is a difficult problem. I mean, with these, like with the accruals, you have those kind of summary measures that include lots of different items in it. You know, within the accrual bucket, there can be heterogeneous buckets, just like I showed you, you know, transitory, mixed, and persistent. So at least this way, we're kind of trying to get a bit more, we're looking at the specific kind of economic characteristic, like discontinued operations or litigation settlement. But again, like litigation settlement, most of the time when a company reports it, they pretty much try to close down any more litigation in that particular aspect. But you could imagine that some of it could be persistent even with litigation. But we generally, you know, so we just have to, make a decision and then go with it. And you'll see that we make some decisions and then we try and see what other people think and whether our views correlate with theirs in a second. So we classify discontinued operations and litigation settlement costs as high quality exclusions. And then we have sort of these neutral exclusions where we kind of go, well, they could be one-off or they could have this kind of mixed attribute quality. So we're not really sure exactly how to classify them. So examples of exclusions that fall into that category are mergers and acquisitions, as I mentioned before, because it's kind of like, well, you know, it's more of a investment in some sense, and then I would amortize it. But if you're doing it continually, it seems like that doesn't make sense to exclude. And then gains and losses of sale of PP&E. On one hand, that's showing that they haven't depreciated the asset quite correctly, but you're not likely to see it reoccur. So we put them in the neutral category. So we come up with this scoring system that you see on this slide, where we rank certain things as low quality, such as depreciation and amortization. And then we move down to high quality, which includes accounting rule changes and discontinued operations and litigation charges and things like that. And then we want to validate it, just because, as you pointed out, like Paul pointed out, many others, you know, well, how do we know that we're consistent with what other people think? And the group that we felt was most appropriate to us was academics, because we don't really have any agenda. We kind of think about these things and have a big picture in mind. So we surveyed academics. We surveyed, I presented the paper at a couple of conferences, so we got their input beforehand, before they saw the paper, and also asked at various universities. And we had this survey where we asked people to rank items based on whether they thought it was reasonable to exclude or unreasonable. And you can see and we sort of randomized the mix there of the items. So how did the academics rate this? Well, their ratings were fairly similar to ours in terms of what they thought was unreasonable and what they thought was reasonable. We also asked some analysts to rate it. They had less distribution. I think they were more concerned with, oh, well, whatever managers want to do, you know, is fine with us. So then we looked at the correlation between the measures, and we found with the academics, how they scored it versus our exclusion quality score, there was about an 84% correlation between the two, which we thought was pretty reasonable. It was lower with the analysts, so down at 57%. We also looked at the Chinese regulators have some exclusions that they think are reasonable or unreasonable, and we found our measure was fairly correlated with theirs as well. And then most responders said, yes, they thought it was reasonable for companies to provide a non-GAAP earnings measure, just because earnings have all these mixed attribute qualities. So here's an example of applying the rating system. So this is a Transdim group, and you can see that their net income's 596 and their EBITDA defined was 1710563. So the difference was 1,050,368. And then what we do is we look at the score, we see how much the amount is, and then we come up with a weighted average score. So this company had a lot of red items, as you can see, and they get a low quality score. There's a lot of prior literature on non-GAAP earnings. So we use that literature to see what how people have defined quality, and borrow some of their tests to examine whether our quality score is correlated with what you'd expect to see based on what people have looked at in the past. There's a lot of research in this area. It's very big.
Patty, I
My
think we
co-
have one or two questions. Do you want to take it down or you want to wait
Yeah,
a little
sure.
bit? Okay,
I think
Paul,
I can take it.
do you have another question? Oh, you're muted, sorry.
I think, Paul, you're muted. You have to ask me.
Yeah, sorry.
Okay.
I may have preempted what Patty's about to say, but is this, so you said they were a low quality, was a 1.7, I think it was.
Yeah.
I assume you're gonna correlate that with like the return to the exclusion or something like that? Is that okay? All right, so
Yeah, so what we do is we get our sample, we look at all their exclusions, we get this weighted average score based on what they exclude and how the magnitude of the exclusion, and then we look across all firms each year, and we can see the distribution of the score, you know, and it ranges from 1.x to 4.x really. And then we can we've sort of categorized them in various ways. So we've done it on the actual score as well as just the distribution, like putting them in buckets from high to low based on their scores, you know, 1 to 5. Does that make sense?
yeah.
Okay.
And then
So,
the other comment and is in the chat from Joshua Libnat. He mentioned that another thing to potentially consider should be big bath charges, for example, like changes in management. Yeah, this is potentially for later.
Oh, like to
Like CEO, I imagine like for example when they have a change in CEO and then you're gonna have like some charges.
yeah, true. So yeah, I guess yeah, we would classify most of those big bath type of charges as either neutral or low or high quality, I think. So you can see that you'd want to be able to also look at the incentives, what was going on around that time as well. So yeah, so when we looked at prior literature, as I said, there's a lot of analysis of whether non-GAAP exclusions are high or low quality, and they usually break them down into non-recurring and recurring items. And because of how hard it is to collect this data, people have looked at various number of exclusions. So 7 exclusions, 8 exclusions, 13 exclusions, and 15 more recently. So we do the same sort of thing, and we use this audit analytics sample. We did collect our own sample as well. It was very hard to collect the data actually, but and though we also validated it against the audit analytics. But we'd like to collect more of it, basically. So so what is prior literature? They've looked at future performance and found generally that non-GAAP earnings is higher quality than GAAP earnings. It's more persistent and better at predicting future cash flows. Regulation shock. So what happened after Reg G was introduced? You know, did firms report more transitory components? That was yes for a while. Managerial incentives. You know, are they doing it for informative or other reasons? And the results kind of polarized on that. And then a variety of predictors. And then people have looked further at narratives of disclosures and then predicting exclusion persistence. So what do we look at with our measure? The first one there is that we look at some of the persistence and consistency predictions, but I didn't include them in this presentation, which I guess was brought up earlier. But anyway, firms with low non-GAAP exclusion quality are more likely to face stronger market pressure to meet or beat earnings expectations. So are you going to use not low quality items if you need to meet expectations? That's kind of our prediction there. And so we look at some descriptive statistics on market pressure, such as, you know, prior stock returns. So if you've had a big run up in your stock, are you more likely to want to meet expectations to keep your stock price high? Are you doing it for stock compensation reasons, which, as another kind of incentive. We thought it would vary by firm size and firm age, just like sort of younger firms would have lower quality just because they're more concerned with the market. We didn't find any relationship with financial reporting quality, which was kind of good for us, I guess. Then we did a regression analysis where we also put it into regression and looked at controlled for various factors like industry fixed effects and year fixed effects and the other stuff we all do. And our results generally kind of held, I guess. I don't know whether we have any. Well, we have one T over 2.01, but the rest are kind of all over the place. But so we found results kind of consistent with that, with our exclusion quality score. And then we looked also at whether predicted that firms with lower non-GAAP exclusion quality scores are more likely to beat analysts' expectations by using discretionary exclusions. And then our third one there is firms with lower non-GAAP exclusion quality scores are more likely to come under SEC scrutiny because the number that they're reporting is actually a persistent measure. I think Brett's got a question.
Hi, Patty. Yeah, I was
Hello.
really interested in your research question about SEC scrutiny, but I was curious about how you chose your sample period, just those 5 years, because I think the regime has shifted from time to time. In 2010, for example, the SEC put out a C&DI, compliance and disclosure interpretation, to reduce some of the disclosure burden and making it easier for firms to disclose these non-GAAP measures that are out there in the media and so on. And then that pendulum kind of shifted again during your sample period in 2016. So any thoughts on different regimes, different areas of focus by the SEC, how that would influence the way you're thinking about this?
Yeah, I mean, I guess it would influence what was being reported over time. So you might see changes in quality, which we do have a graph of that, but I didn't include it in the presentation, where it was kind of, they seem to be higher quality early on, and then they've got lower quality, as time goes by. And I guess companies forget about what the SEC's been saying. They start doing more extreme things. But I do think that's kind of an interesting aspect that we could explore if we had we basically get our sample from audit analytics. So that's the kind of years that they collected the data.
That's the constraint. I understand. Okay.
Yeah. So, I mean, depending on what we would like to extend the sample, but it is quite a big project because you need to have quite informed people doing it, because it's quite hard to find the reconciliation tables and then getting the items and classifying them.
One idea, you may just split it on 2016 and do a pre-post with what you have. I think that's kind of the middle of your sample, perhaps. Based on what you're doing so far. And then I'd be really interested back in time, just because I'm old and I'm interested in early 2000s, what was going on. So thank you.
Yeah, I'd be interested back in time. And you're not old, by the way, because if you're old, that means I'm old.
No, I think we have another question from Wakar. Let me just ask one question in the chat that was asked. I was just waiting a little bit. So Kyung Kang asked, how about, have you guys also looked at cash versus non-cash items? Do you think it's potentially relevant for the system, the rating system? I
believe that yes, I think it would be relevant. I think that the SEC kind of says if it's non-cash, it's more, it's okay, from what I understand. So you do tend to see there are, non-cash items more than cash items, because cash, they're not allowed as much. But, like litigation costs, I guess that's going to be a proxy for cash. So, yeah, I think that's pretty interesting too. We haven't gone down that road because you can imagine it's quite difficult sometimes to know what's cash and what's not and when. But it's certainly an avenue. See, I'm like delegating a lot of this to future research. Yes, I believe you can see that there's a lot of potential to go think about it once you kind of have this aspect where you can start ranking firms. Because before it was such a big mess and everybody's like, oh, that non-GAAP literature, I hate it because I don't understand it. But I feel like this way everyone can start getting a better grip of it, and we can start really trying to answer some of these interesting questions. So thank you.
I totally agree. We have one on the order, first Ali and then Joshua, please.
Hi, Patty. I just wanted to double check I'm just trying to draw a parallel to the balance sheet. So we have non-GAAP earnings that exclude expenses, but we have lots of upward potential in assets that doesn't get recognized because of strict recognition on assets. So I think sometimes fair value options are prescribed by the managers, or they'd like to showcase workforce or R&D efforts and things with lots of prominence as well. So in effect, they're trying to come up with a non-GAAP sort of equivalent of assets as well. So do you think that side of the story would also complete this picture? Because earnings is one, but we also value based on assets. And there's a lot of fair value options that managers pursue when they see upward potential of revaluations and things like that.
Yeah, I mean, yeah, because the accounting rules tend not to let managers value up. And then a lot of those assets are
Or they don't
expensed.
let them recognize assets, for example. So they put
Yeah.
that big brochure up on the front end saying we've got lots of big facilities, our workforce is amazing, customer base is huge. That is also non-GAAP assets, so to speak.
Yeah, I think that's a really good point. And the accounting system's not trying to do anything to capture those. So I think it's really relevant for this seminar series, just because it highlights all these issues where we're failing at our job as accountants, really. I think, we need to be, because the industries have shifted, right, towards technology, and I think it would be useful for us to be doing more on that kind of measurement instead of letting managers just make up their own numbers. But, luckily I'm not in charge of standard settings, so I can, say these things. I know it's much more difficult to do in practice.
Thank you.
Yeah, but it's a good aspect. Yeah, definitely.
Can I ask a related question? I know Josh raised his hand. Hi, Pat. This is
Hi,
Agnes.
nice to see you.
Yeah, hi, nice seeing you. So the related question is actually, I think, like Wagner asked about asset and one I see cash flow. And actually, that many firms, they provide non-GAAP, like cash flow from operations, so free cash flow, and also non-GAAP asset, And so I was just kind of wondering but they don't, I think you are focusing on companies provide non-GAAP earnings, but quite a bit, they don't provide non-GAAP earnings, but provide non-GAAP others. So maybe you can kind of look into it, how that differ, and why would company, provide that, how those will be useful.
Yeah, because you do see that vary by industry, like, in real estate investment trust, funds from operations, that kind of thing.
Yeah.
And like EBITDA is supposed to be a measure of free cash flows, so they're definitely, they're definitely trying to get to those kind of measures that they believe are more relevant for valuing the future, like a future cash flow proxy. But then they sort of don't take it the full way and think about capex or some of these other aspects. So it's kind of, that's where the ambiguity lies in, where investors could misvalue them in some ways if they don't consider capex, for example, with EBITDA type free cash flow measures, or with real estate.
I don't know if it's my turn.
It is. Please go ahead.
Yeah.
Hi, Pat.
Go ahead. Hi, nice to see you, Joshua.
Yeah. So I'm just wondering if you gave any thought to the possibility that managers monitor market reactions to their non-GAAP exclusions to guide their future exclusions.
Oh, and what do you mean? Like if people ignore
if managers try to monitor how the market and investors are reacting to their exclusions, such as to guide their future exclusions?
Well, we haven't looked at that specifically. You'll see that we do some tests to see whether investors find some exclusions more, or low quality exclusions, more difficult to interpret. I know that managers sort of get stuck excluding certain items, and even when they become less relevant, which I think was earlier on, someone was saying, looking at the time series of exclusions, like Apple used to report, I forget something about the number of iPhone sales they had or something, but then they decided it was no longer relevant and the stock price went down when they stopped reporting that non-GAAP measure. So I think that's a really interesting aspect, but we haven't looked at it in this paper. Again, could be something that people could look at in the future, how that
Thank you.
works.
Great question. I think we have one more question / comment on the chat. I am not gonna be good enough to to be able to ask the question for Basu. Basu, do you wanna
So I was just reacting to the comment that human capital is the firm's asset and should be recognized because we've banned slavery, so the firm doesn't own the employees. The human capital belongs to the employees. So even though they might have economic value to the firm, it's not the firm's property. You can rent human capital, that's why you pay a salary, but that's not the same as owning it.
Oh yeah, but same with leasing, right?
Yeah. Like,
And consolidation, you could argue the same thing.
Depends on the kind of lease. With the capital lease, if you have that bargain purchase option, you are going to end up with the asset.
Yeah, I know. Well, now they capitalize operating leases, so I'm on safe ground now. But yes, I feel like yeah, sure, you could argue the slavery thing, but then you could also, slavery, I shouldn't say it like that. Yeah, of course they're not slaves, because if they were slaves, they wouldn't have to pay for them. But
balance sheet, we no longer put people on the balance sheet.
Yeah, it's true. I mean, I guess you've done history of accounting, so I'm not going to argue with that. But yeah, I mean, I feel like we could spend a lot of time thinking about different accounting systems and like stock compensation. Is that an asset? Could you create an asset with that rather than calling it debt? Or no, they put it as a contra equity account, don't they? So yeah. But I know where you're coming from on ownership, but we don't require ownership for a lot of other stuff. So that's why I feel like it's going beyond, we could think of human capital as assets, definitely. I think most people do think humans are valuable, especially in these tech firms where they provide it's all creating new software and all that kind of stuff. Maybe now that we got this AI stuff, it will all go away, though, of course. I don't.
We'll see.
I know.
Great questions. Patty, I just want to make sure I keep on track. I'm doing a poor job, but you still have 8 minutes. So 3 more minutes potential for questions and then 5 minutes uninterrupted, but please.
Yeah. Okay. Yeah, I think I'm getting there. So so we look at whether low quality, this is another aspect that prior research has looked at. So a lot of our tests, I feel like, you probably may, if you know this literature, you might have seen them before, but we're just putting them into our context. So firms with low non-GAAP exclusion quality, are they more likely to beat analyst expectations using discretionary exclusions? And then, the SEC, are they more likely to come with the SEC scrutiny? So a discretionary beat we define as the scenario where managers' non-GAAP metric meets or beats the analyst consensus forecast, but the actual earnings, like the street earnings reported on IBIS, misses a consensus forecast. So you have non-GAAP earnings, street earnings, which is what the analysts have agreed to exclude, and then you've got GAAP earnings. So the agreed upon exclusions they miss, but then they add some extra exclusions and then they beat. And we find evidence consistent with this, more likely to beat with these low quality, if you've got a low quality score, suggesting that they might be adding a few extra things that we classify as low quality. And then we look at comment letters and Reg G and find that low quality ones are more likely to get future Reg G violations or have some comment letters. So that's kind of interesting, I thought. And then we also go ahead and ask, do analysts have a more difficult time forecasting earnings because they have to decide what to exclude and include in their forecasts of earnings? When you've got low quality, if you're dealing with a low quality non-GAAP exclusion firm, do analysts have a more difficult time just coming up with a forecast because they don't know what to include or exclude? So is analyst dispersion greater for low non-GAAP exclusion quality firms? And then does it take investors longer to assimilate the information and earnings announcements when we've got these lower non-GAAP exclusion? So this is our tests of the relationship between non-GAAP exclusion quality and analyst forecast dispersion. And you can see we include lots of control variables in there. And we find that the relationship is the way we predict, that firms with lower exclusion quality scores tend to have higher forecast dispersion, consistent with analysts having a more difficult time forecasting what the earnings are going to be for those firms. Possibly because they, after controlling for all those other factors, they don't know what the firm's going to include or exclude, and some of them are coming up with different measures based on that property. And then we do some speed of price discovery tests, where this is a kind of test where you see how long it takes for the stock price to respond to the earnings announcement. And we took it from this paper by Blanksboard, Dechow, Marinock, JE 2022. And if it takes longer for investors to assimilate the information in the earnings announcement, then you could say that the information was kind of lower quality, in the sense that it was more difficult for people to understand what was going on at the company. And so we look at that in table 8, and we find a relationship between the exclusion quality score and the time it takes for the information to get assimilated into price. So that was also what we were hoping for. So in conclusion, we develop a system for rating non-GAAP exclusion. We provide survey evidence from academics to try and validate our rating system. So do other academics agree with us? I would have sent it out to everyone here beforehand, but you had the paper, so I didn't. It was a bit confounded. Then we provide evidence of the usefulness of our rating system. So we show how the descriptive statistics can pick up trends over time and across industries, which I didn't include some of those. And then we provide evidence that the quality of the rating varies consistent with predictions made by prior literature. So firms with more market pressure seem to have lower quality ratings, and the reactions of regulator, analysts, and investors, they respond differently to firms with high versus low ratings. So we feel like generally we provided some supportive evidence that our non-GAAP exclusion score is useful. And we hope that it's going to be used by future research for testing other predictions that were raised today by many of the participants. You can see how you can apply it in other situations. Yeah. Oh, and I'm supposed to put this up too, that the next virtual event's going to be on October 3rd, Tuesday, 12 p.m. to 1:30 Eastern time, and it's on disaggregation. And the presenter will be Sid Balachandran from University of Illinois at Chicago. And there's also another paper by Patrick Boyce on the informativeness of the balance sheet disaggregation evidence from forecasting operating assets. So with that, I will thank you. And if there's any other questions, I'll stay online for a few more minutes after we finish. So yeah, back to you, Judson.
Thank you so much, Patty. As you can see from the questions, right? Like, yeah, there's a lot of like potential future research. So I think we're all excited to see the paper like get published and
hopefully.